Hey there everyone, Dave Keller here with Market Misbehavior, and we're back with one of our popular videos, which we call the Choose Your Own Adventure style video. Here's the way this works. We're going to present to you the chart of the S&P 500 along with 4 potential outcomes over the next 6 to 8 weeks. We'll talk about a super bullish outcome that would involve the market essentially continuing the resilient uptrend we've had off of the April 2025 lows, all the way down to a super bearish scenario, which would have the S&P 500 undercutting the 200-day moving average, maybe breaking a little bit further. Now, why are we doing this exercise? It's all based on an approach which I call a probabilistic analysis. We basically lay out 4 different scenarios, which forces us to think outside of our preconceived biases. You're probably already kind of bullish, kind of bearish on stocks right about now, but by watching through these 4 different potential future paths, it forces you to consider some alternate scenarios, to think about what a really bullish environment would look like, what kind of stocks and themes and patterns would emerge, what would indicators and charts that you follow probably start to look like. We'll also think about some very negative outcomes. What would a risk-off scenario look like? What kind of stocks and themes would move? What would the dollar, or interest rates, or crude oil prices probably do in those scenarios? By forcing ourselves to consider different alternate scenarios, it helps us to break out of those behavioral biases, which may, too focus us on one potential narrative at the expense of ignoring some other, possibilities that could happen. Here's the way we want to do this. We'll share with you the 4 scenarios. Make sure you leave a comment below the video. Tell me which scenario you see as most likely and why. And there's a benefit there because that'll allow you to sort of formalize your outlook, right? Talk about your own perspective and explain briefly why you came to that answer. But also you have the benefit of seeing what all the other people watching this video think. And that can be helpful as well, kind of therapeutic actually, to recognize that some people are actually quite bullish and quite bearish and a lot of people in the middle in any market environment. So we'll talk about the 4 scenarios in a minute. We're going to start looking back at the last time we did one of these videos, which was back in May. You'll see which of the scenarios actually played out. Before we get to that video, the outcome and all the 4 scenarios, here's one more thing I want to tell you about. I spent many years earlier in my career working for large financial institutions, and when I left the institutional world, I remember thinking, what am I going to do to replace these big, expensive, but powerful institutional investing platforms that I've had access to this whole time? There is an option now for individual investors and financial advisors, and it's called Kifin. Kifin really combines some of those great capabilities of the big, expensive institutional platforms, along with some capabilities really optimized for financial advisors and high net worth individuals, and puts it in a very low cost, underpriced package on a web-based platform compared to the possibilities that you can achieve by using said platform. One of the features I love to use on Kifin are the ETF holdings. You can take an ETF, you can, like the QQQ, you can look at the biggest weightings, you can look at weightings by sector, you can run some basic attribution analysis. So for ETFs that you own or that you're considering owning, doing the due diligence of really understanding the exposures you're going to get is super important and super powerful for your portfolio. If you go to marketmisbehavior.com/Kifin, you can get 10% off any new membership. I hope you will check it out, and I hope you will find it as meaningful and powerful and impactful as I have found myself. Now let's get back to the charts. All right, so first let's go back to May 7th, 2025, which was the last time we did one of these Choose Your Own Adventure style videos. We laid out 4 potential scenarios. And this is a really cool time for the video to come out because it was right after a month of a rally, after about 2 months of a significant downtrend with tariff tantrum, all the new Trump policies all sort of getting lit up, the market rotating lower aggressively, April 7th, major low, into May 7th, right? That 1 month period, remarkably strong. The S&P had just gapped up after a number of other gaps, had pulled back a little bit, and that was the day we put out the video. If you look at what happened with the market action relative to these arrows, you will see that scenario number 1, the super bullish scenario, matched almost exactly what happened with the S&P 500. As we discussed in that video, in the super bullish scenario, that was all about a continuation of the early optimism. Because if you remember, a month into that short-term rally, it was a big question mark as to whether the market would be able to sustain those early gains. So we talked about the strength we would need to see in leading growth stocks, the Magnificent Seven names. We talked about how offense would have to outperform defense, how conditions in that rally, all the tariff issues would have to be pushed down the road. All of those things certainly played out. So the S&P 500, about a month, 6 weeks later, we'll call it, was right around 60.50, pretty much right at the end of that green arrow. And since then, of course, we've continued to move even higher, with the S&P making new all-time highs above 62.50 for the first time in history. If you guessed one of these other scenarios, I think one of the benefits of this type of analysis, what we call probabilistic analysis, is we forced you to consider scenario number one. So as the evidence sort of further supported that scenario one was playing out, hopefully you had an opportunity to rotate from more defensive positioning or risk-off positioning to go risk-on, to step on the gas and follow that uptrend higher. So with that in mind, let's talk about the four scenarios as we see them today. So what's happened since we recorded that previous video on May 7th, we've obviously had a big gap higher as the tariffs relative to Europe were announced. From there, we saw continued uptrend. This week, we've had continued, additional news flow related to tariffs with proposed tariffs with Japan and South Korea. Potential tariffs with Europe being pushed down a little bit into early August. So these scenarios basically go through the next tariff deadline, which would be in early August. We're basically looking to mid-late August with this particular outlook, about 6 to 8 weeks out from today's session. So scenario number one, the super bullish scenario, I would argue is a continuation of this uptrend. I think the trend in the S&P 500 off of the August lows has been nothing but remarkable. We've had exceptional strength. We've seen leadership in technology. Other sectors, things like financials, at some points have come on and joined the fun. Communication services has been another sector that's been quite resilient. It's been growth over value. It's been offense over defense. It's been high beta over low volatility. And the super bullish scenario would basically mean all of those things continue to work. So I guess what we would have to keep in mind in this super bullish scenario is that all the negative macro conditions, potential escalation in the Middle East, flaring back up, the dollar, which has been weakening, maybe starts to rotate higher. Maybe we get noise from the Fed that cuts are not as soon to be had, and maybe the Fed pushes their starting point down the road to later in 2025. Those are the kind of things that would disrupt this super bullish scenario. But scenario number one would mean the Fed probably cuts at the September meeting at the latest, maybe a cut earlier, but that seems highly unlikely. Markets pricing in that first rate cut for the meeting later in the fall. So scenario one would basically mean all the data sort of supports economic growth slowing, compelling the Fed to take action as soon as they can. As a result, risk assets continue to move to the upside. So scenario one, the super bullish scenario, more of the same. All the stuff that we've observed in late May through the month of June continues through July and into early August. This would, I would argue, follow the seasonality, because July has been a remarkably strong month. Since COVID, July has been up 100% of the time. It's always been a positive month. So this would follow the seasonal tendencies. We have had major peaks in August before. Maybe that's what happens again here in 2025. So scenario number one, if that's your vote, make sure you drop the comment below with scenario one and why. What particularly out of the things that I mentioned you think is the most important reason why? Now, scenario two, I would argue the market still goes up, but the pace starts to slow. We've had arguably an unsustainable rally in risk assets. A lot of people are concerned that so many things, from big technology stocks to banks like Citigroup and JP Morgan, all becoming overbought. As a result, the market starts to pull back a little bit. Now, it's not enough to cause a cyclical downturn. Scenario number two is still a bullish scenario, just less so, right? So maybe the leadership starts to shift a little bit. Maybe the Magnificent Seven are no longer the leaders that we have expected them to be. Charts like Apple, Alphabet, Tesla, not looking particularly strong here. Those are names that have actually struggled to get above resistance. They've failed to follow through, so maybe they continue to languish. So some of the Magnificent Seven names, like a Meta, maybe break out, but Others like Alphabet and Apple start to struggle. Q2 earnings is not as strong. It's not horrible, but just kind of less rosy. As a result, we start to see some initial profit taking. Maybe we see some chopping around, but in the end, by mid-August, the S&P is slightly higher, and that's what I think what differentiates scenario number 2 from scenario 3, which is a mildly bearish scenario. So scenario number 2, maybe we start to get some economic data that's more mixed. Maybe we're talking about the Fed maybe not being as aggressive as we've expected. And maybe the leadership trends start to change a little bit. Maybe the dollar pops up a bit because of renewed optimism for economic growth. And as a result, risk assets start to slow down a bit. So that's scenario 2, the mildly bullish scenario. Again, if that's your vote, make sure you put a comment below, say scenario 2 and why you think that's the most likely outcome. Now we get to the fun ones, the ones that are not so optimistic. Scenario 3 is the mildly bearish scenario. I would say scenario 3 is where the S&P's top is probably in. Maybe we go slightly higher, but we don't go much higher than we have already. I would say in this scenario and the scenario number 4, we don't get above 6,300 as a ceiling, but we do end up testing the 200-day moving average. And I think that's what scenario 3 looks like. We stop going up, we start going down. It's not end of the world down, but we pull back enough to test the 200-day moving average for the first time since May. That pullback scenario basically puts the S&P down in the 6,000 to 6,100 range, somewhere in there. And I basically have extended the current 200-day moving average out a little bit, just assuming we have a consistent slope. It could be somewhere in this range, depending on what happens to the price action between now and then. So the dotted line is sort of an estimate of where the 200-day probably is. And scenario 3 means we test the 200-day moving average. What's interesting is the economic data could actually come out as pretty strong, but as a result, that could mean the Fed holds off or is expected to hold off with their rate cuts. That is what causes stocks to go down. Maybe it's because Q2 earnings has a lot of companies talking about the impacts of tariffs. There are a lot of macro strategists I've been talking to that think one of the reasons why the S&P and the NASDAQ have continued to show so much strength is because the market's pricing in basically tariffs are not going to be a huge influence, right? They just won't be that big of a deal. The scenario 3 here and scenario 4 would mean tariffs do end up being a bigger deal than the market has been pricing in. Maybe companies talk a lot about how they've been working through their existing inventory, but now they're probably going to have to buy higher priced goods from overseas. And as a result, they're going to have to raise prices for consumers. That would cause risk assets like equities to start to go down. VIX probably pops above 20 in that scenario number 3. And I think that's one thing with scenario 3 or scenario 4. Watch the VIX to see if we see that spike higher. So if scenario 3 is your vote, make sure you drop that in a comment below and explain why you see that as the most likely scenario. Now, we also always have to have a dangerous negative scenario, scenario 4, the super bearish scenario. Here's how I could see this playing out. Let's say inflation ends up spiking. Let's say tariffs become a huge issue. Let's say the headlines from the Middle East take a deep and dark turn to the downside as events re-escalate. The mirage of peace ends up being a mirage, and all of a sudden things start to get very ugly very quickly. There are so many macro drivers that could cause risk assets to go down. I tend to be more simple in my approach, and I would say scenario 4 happens if the leading names that have dominated the uptrend from April through July, I'm talking semiconductors, I'm talking technology, some communications names, banks, stocks that have done remarkably well really start to struggle. Defensive sectors start to improve, things like utilities, consumer staples, REITs. As investors get nervous, it starts to be a negative feedback loop. That initial sell-off causes some additional profit taking, increase in fear, increasing volatility. That causes more investors to get more defensive. That causes more fear, and we see how that waterfall decline can very quickly escalate. What differentiates scenario 3 from scenario 4, the bearish scenario, the super bearish scenario, is that we blow right through the 50-day moving average and right through the 200-day moving average. I don't see a scenario where we get much below 5,700 over the next 6 to 8 weeks, although that's certainly possible. So anything at or below that level, we'll call that scenario 4 the very bearish scenario. This, I think, is a reasonable expectation of kind of a risk-off move, right? Investors get pretty nervous. Scenario 4 would look a lot like mid-February to kind of late March, that kind of move. Similar move would take us down around 57 to 5,800. That, by the way, would represent a 38% 28.2% retracement of the April low to the July peak, if that is indeed the high. So that would be a reasonable downside expectation based on a basic Fibonacci framework, and would also take us back to that gap we had in early May, basically retrace 100% of the way back to that price gap. So if that's what you think is the most likely scenario, make sure you drop a comment below scenario 4 and why you see that very bearish scenario as the most likely outcome between now and late August 2025. There we go. Those are the 4 scenarios that we could see playing out over the next 6 to 8 weeks. The very bullish scenario, pushing the S&P onward and ever upward, making new all-time highs, going into a traditionally seasonally weaker part of the year in August, all the way down to a very bearish scenario where the S&P has made its peak for the summer. It starts to sell off. The 200-day does not hold, and we're talking about further deterioration, a retest of that price gap from back in May. Make sure you drop a comment below. Which of those 4 scenarios do you see as most likely and why? Make a vote. Explain your justification. Once you've done that, maybe check out some of the other comments and see what other viewers are thinking. That's it for today. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts.